Welcome to Caliente Topics. This is your daily tax webcast. My name is Veronica Russell from MMTAXMAN.com, and I have on the other side Patrick Russell, EA, as well from MMTAXMAN.com. Good morning to you, Patrick. Happy Friday. And on today's webcast, we're going to talk about ordinary losses and capital losses, right, Patrick?
Excellent, Veronica. TGIF. To continue on our course as day traders, I really wanted to have a conversation about the difference between what's a capital loss and what's an ordinary loss on your tax return and the limitations for both. I think it would be helpful to have a conversation about this topic before we jump into the IRC 475, the election of treating your stock sales as a market-to-market category as opposed to a traditional capital gain and loss transaction. All right. To start off with, on the capital loss side, you create and generate a capital loss when you sell an asset. In this conversation, let's stick to stocks at a lesser price than the price that you paid for it, aka a loser, right? Okay. And so first, when it comes to these capital losses, you net them all together. Year end, all of the losses take to a netting process. Essentially, you tally up all your losses first on a long-term and a short-term loss basis. Quick question, Veronica. How long do you have to own a stock for it to be a long-term loss?
More than a year.
Very good. So the first thing you do is you take your long-term losses and net them against your long-term gains. If you have more that exceeds the long-term gains, then you shoot for the short-term gain. Any short-term gain or short-term gain is eliminated. Now, if you have any loss that exceeds your short-term gain, this is where the limitation applies. So you have your capital gains, but then you also have your ordinary income items like your W-2 and wages, your interest income, your dividends, your profit from your business. All of these incomes are considered ordinary income, not capital gain. Question, Veronica, once you go through the netting process of using your capital losses against all your stock losers, how much is the annual deduction you can take against your ordinary income every year?
At $3,000.
That's exactly right. And even in years where your losses exceed that $3,000 limitation, they now get suspended and carried forward. They get carried forward as a long-term capital loss, and it gets carried forward for 20 years. Same limitations will apply throughout the life of that deduction. And so there's the big quandary when it comes to, do I keep my stock trades as a capital gain item, or do I make the election to go with ordinary income rules with a market-to-market election? Why? Because let's talk about ordinary losses. Ordinary losses occur when there's an item in your ordinary income category, such as a loss of a business or the loss of a loss that you incur from the operating of a rental property, which sometimes brings your entire taxable income to a negative, creating what they call a net operating loss. Okay, now this is different because a net operating loss, there is no limitation. Now, Veronica, I know that you can take back a net operating loss from ordinary income back 5 years. They've changed it in 2018 because of the CARES Act. It used to be a 3-year carryback window. It is now currently a 5-year carryback window. Question, how, if you elect to forego your carryback of 5 years, how much further into the future can you go with your NOL?
At 20 years.
Exactly right. So 20 years is kind of like the striking point to know that you've got a big window in order for you to absorb those losses, either taking them back 5 years or electing to forego those carryback provisions and using your NOL in future years. More than likely, you'll be able to exhaust it well before the 20 years are up. Now, the important thing to realize is that there is that limitation of $3,000 that will prevent you in a really bad year where you have a lot of losses and not a lot of gains and you have this enormous loss. Unfortunately, the best that you can do is use the $3,000 against your ordinary income for the current year, and then have, once again, a long-term carryover loss that you'll be able to use against your winners in the future years. Any questions on that, Veronica?
No, I think it's pretty clear for everyone that is trying to sell stocks or some type of losses carry forward or going back. This is an important webcast.
Very good. So you have, remember, investors that are just your ordinary Joe Schmo who, as a hobby, does day trading on the side. He has his main job. We understand that the capital losses would apply to his trading transactions no matter what. It is the traders, AKA day traders, that have the opportunity, because they've established themselves as a business and not just as an investor and just doing this on the side, but this is his main activity, main job, main source of income, is what he does primarily throughout the year, and he uses the money for his livelihood. Once he meets those measures, the trader now has the ability to treat his trades and his sales, both gains and losses, as an ordinary income type. And now we'll see, because we understand the limitations on the back end of what it means if you don't change a capital loss, capital gain item into an ordinary income item, what limitations you're faced with. Next webcast, we'll jump into now the IRC 475 regulation that allows a trader, a person that does this for a job, to be able to elect to use his trading activity as an ordinary income base. We'll talk more about that. Any questions on your end, Veronica?
No, guys, remember, we're not lawyers, and this is not a paid consultation. So if you like a consultation, email us at mmtaxman@gmail.com or send us a text message to 562-756-9924. Thank you, Patrick.
Have a great day, guys. Have a wonderful weekend.